Today we're talking about Form 5471, but if we're going to talk about that form, the first thing we need to talk about is CFCs,
right,
or controlled foreign corporations.
Right.
Okay.
Controlled foreign corporations. And this is where, I'm going to go over some terms that the first time I heard them, my eyes glazed over. And maybe the 10th time I heard them, my eyes glazed over. So it takes a while to break things down.
Yes.
Okay. So let's back off a little bit. We'll just say controlled foreign corporations. Those are three words we can put together without too much confusion, right?
Mm-hmm.
So what is what's a corporation? Well, it's a corporation. Actually, let's just say entity.
Mm-hmm.
Foreign means offshore, and controlled means controlled by 50% or more of a U.S. person.
Okay.
Okay. So there's a controlled foreign corporation. Now, why the heck is it important, I think, is the real question to ask. What does it mean? Why would you care? Why do you want to avoid it? Mm-hmm. And it all comes down, and if we're going to talk about, and we're talking about international taxation, and if we're going to talk about international taxation, we shouldn't go any further if we're not going to talk about deferral. Okay, so this is one of the terms that may cause you to glaze over, as it did to me the first time I heard about this, and so many years ago. Mm-hmm. So deferral is the game of all international tax planning. That's what you're trying to do when you move things offshore, typically. Mm-hmm. Okay, for tax planning purposes, trying to reduce your tax. If you're looking to avoid taxes, the whole thing you do it is to defer taxes, so that whatever grows overseas grows tax-free, just like a 401k.
Exactly.
And so then the question is, look, why don't you just use a 401k and then instead of going through all these things? Well, because you make too much money, you don't qualify. So for a lot, and the investment might not be what you're really looking to do too. That the 401k is only going to be in certain things. You're not going to be able to do a small or medium-sized business that the business really well at.
Exactly.
So that's what you're trying to do. Deferring your income means it can grow tax-free, and just some basic calculations on the differences of it.
Yep.
So let's just say that you have an 8% return a year, and it's allowed to grow tax-free, and you start with $100,000.
Okay.
At the end, you'd have $340,000.
And that's after 30 years.
That's after 30 years.
Got
now, of course, it's when you repatriate the money, bring it back to the U.S., is when it becomes taxable.
Got it.
Okay, so that $340,000, there would be tax due on the principal if you were bringing the whole thing back in 1 year, which most people wouldn't do,
right,
to the U.S. Compare that if you were now that 8% is only yielding you 5% after tax, which is a pretty fair assumption. Mm-hmm. At the end, you'll have $250,000.
Okay.
Okay, but at least hey, look, that $150,000 you earned, pretty much all the taxes have been paid on. So those are some of the numbers that we're talking about, and you could even see in situations where the effective tax rates can really get up there, especially when people, in all states. Well, and I shouldn't say all states. Most state taxation is based on what your federal adjusted gross income is.
Yep.
Okay, most of it is. So if your federal adjusted gross income goes down, so does your state. So you're able to avoid that too. So you could see, in a situation, well, maybe it'd even be, maybe the difference would be 5 percentage points. Well, that's a difference of $240,000 over 30 years with $100,000. So pretty significant. So that's the whole idea of when people are using offshore investments to lower taxes, and it used to be for anybody, and we'll talk a little bit about some of the changes that happened in 1962. But it used to be anybody could set up. A doctor could set up a corporation in wherever and let the stuff grow tax free. And it's always one of my points when people say, "Oh, we should return to the tax rates of the 1950s." I said, "Fine, give me the loopholes of the 1950s, and I'm A-okay with that because you can avoid like it's completely easy."
Yep.
So really, some of the loopholes were closed to avoid people from doing this. Now the issue is that you get some controlled foreign corporations that are they're not passive. They're actually corporations. They're actually doing things. It could be a farm, a vineyard. It could be an airline. There could be a lot of things that are actually active. And there's a little bit of a tax difference between the two. And Robert and I this is one of our first podcasts we did before we had this fantastic studio. We did a whole thing on Subpart F, and really, and in New York, we'll put a link up to that up there. But we really go into there why international tax planning will work for a Fortune 500 company, but for an individual. Yeah, and I think Robert, Attorney Hansen said, he goes, you know what, for a robust amount of work, you can experience a modest amount of savings as an individual. And that's why, one of the reasons why we're more fans of some of the life insurance products, which are tax-free and grow tax-free, and you don't have to get into all of this offshore stuff unless you want to, which you still can.
It can be worth it.
It can be worth it. So that's one of the, we're a big fan of that. And you can sort of pick your investments too, because that's a big piece. A lot of people don't want to just invest in stocks. That's what people don't realize. They don't want to be in bonds. They know the profit is at the small, medium business, because all that corporate nonsense and sort of self-inflicted wounds doesn't occur. It's something they can control, and they know how to make a buck. That's why they want to be in control. So they're looking for those smaller investments. They just don't want to have stocks, because that's someone else calling the shot and a board calling the shot. And then sometimes you get the decision by committee, which is less than optimal. I would say anyone want to know more about Subpart F, check that out. It's about 35, 40 minutes. I think people like that. So we'll have a link to that. But the difference is that not every controlled foreign corporation is subject to Subpart F. Okay? This is why it's important, because Subpart F is the worst. Okay? Deferral is the best thing you want. Okay, if you could defer, that's great. That's great. If you're just taxed at if your offshore investments are taxed at whatever rate it would be taxed, that's kind of bad. Subpart F is the worst. No, that's just terrible, because what happens, Subpart F, is it takes your interest income, your passive income for real estate is taxed at a lower rate than your ordinary rates. But at Subpart F, it's all taxed at ordinary, and your losses are limited. So that's really why you want to avoid it. So the big way when people have a controlled foreign corporation is they check the box to disregard the entity, to say, look, I am really the taxpayer. There is no corporation here that's paying it. I'm the one who's paying it. So that's the one thing people do, check the box. That's the other word. Heard that a million times. What does that mean, check the box? And it's just on form. Wait, I'm going to get it backwards because I keep saying the wrong 8858. Yes, because 8865 is the one I keep getting it confused with. 8858, checking the box. So that is, so I think we covered controlled foreign corporation, what it is.
Yep.
Over 50% owned, something controlled more than by 50%. So a way to get around it, no longer a controlled foreign corporation if a non-U.S. person has more than 50%.
Right.
Now, I guess one question we could ask is what counts
as foreign?
As foreign.
This was a little surprising.
Yeah, this is an interesting, one of the most complicated areas of trying to figure out what belongs where is where we get to the Commonwealth of Puerto Rico. Puerto Rico is interesting because if you are a bona fide resident of Puerto Rico, your Puerto Rican corporation is not a controlled foreign corporation. It's not a foreign corporation. It's not foreign. If you are not a bona fide resident of Puerto Rico, then it is a foreign corporation. And the filing requirements come down to it. And the test for bona fide residence is at 183 days. So whether it's foreign or not depends on 182 days or 183.
Wow.
Right. So it's in Puerto Rico is really interesting because that if you're a bona fide resident, your Puerto Rican income is subject to Puerto Rican taxes. Now the question posed is what happens if a Puerto Rican corporation controls foreign corporations? Did we avoid our controlled foreign corporation filing requirements? Did we avoid it? And the answer is probably not.
Yeah.
Because we're still looking. Because I would explain like this: you're a Puerto Rican person. You're a U.S. citizen. 100%.
Yep. Okay.
All the law allows you to do, all the law does is say, okay, we'll exempt this, we'll exempt this, we'll exempt this. Okay, but everything else, you're still subject to. So you really have to find something that says, oh, your Puerto Rican company, your Puerto Rican company is going to be exempted from its foreign income. So really, there might be a way to do it, but it has nothing to do with it being it has nothing to do with owning a Puerto Rican company.
Yep.
It would just be any U.S. company or any holding of of the foreign entity is what matters. So that's sort of interesting because Puerto Rico does have some incredible incentives for people down there. 4% corporate tax rate. It's just you want to diversify your portfolio a little bit there.
Yep.
Great benefits.
Okay. IRS Medic, the law offices of Parent and Parent, LLP, real tax attorneys for tough tax problems.